So we're out here for the Aspen Economic Strategy Group meetings. A lot of talk about fiscal issues, monetary issues, but we all have now the key jobs figures. A little bit lighter than expected, 187,000 instead of 200,000. A little heavier than expected on the wages. What did you take on?
The job market is cooling a little to kind of a balanced level, but it's still extremely strong. That's the strongest part of the economy by far, is how low the unemployment rate is, and people can get a job if they want a job.
But what about the wages? We're now, these numbers were 4.4% year over year, I believe it was. That doesn't sound like something consistent with getting to 2% inflation overall.
The way I view it is two things. One, you can't say anything about wages until you actually know what's happening with productivity. We got some productivity numbers. They were strong for the quarter. That's very noisy, but if you have strong productivity growth, you can have wage growth and it doesn't generate inflation. And the other thing about wages is they're not a leading indicator of price inflation. They're backward looking. Wages move more slowly. When things happen, we get shocks, the prices move first and then the wages. So when we see what's happening to wages today, this is kind of an amalgam of a bunch of stuff that already occurred. I think if you want to know if you're beating inflation, go watch the inflation. You know, the price series, and especially the new months of inflation in the core. That's really what you want to be watching.
What are those numbers telling you right now, particularly goods inflation? Is it a bit stickier than you thought?
It has been, but the last couple of readings have been pretty positive. It's important that you raise this goods. Loosely, if you look at core inflation, you got goods, you got housing, you got services, not including housing. And we've much remarked on the stickiness and persistence of services inflation. But we knew that's not where we went wrong over at the end of last year, beginning of this year, with inflation lasting a little longer than we thought. It has been that goods prices, while down, have not gone all the way down to where they were before the pandemic. I feel like that's kind of started, and that's put the Fed on this line. I mean, it's a thin line to walk, but getting the prices down without having a big recession, we're going to Johnny Cash this thing and walk that line, and that's for sure the goal.
So, Austan, we talk about things like the jobs numbers as if there's one national number, when in fact we know there's no one national number. Indeed. There's a lot of individual numbers all around the economy. You have a region that absorbs a fair amount of the economy. Give us a sense of the variation across your region.
Yeah, so the region of the Chicago Fed is almost, but not quite exactly, Iowa, Wisconsin, Illinois, Indiana, Michigan. So it's kind of heart of the Midwest. It's got a lot of industrial. It's the most manufacturing intensive of all the Fed districts. There's a lot of food, there's professional services, transportation and logistics. That's a lot of the distinctive concentration. But as you point out, there's a wide variability within that region. So I went to Des Moines, and in Iowa, the unemployment rate is down in the low 2%. And when you talk to people there about, hey, what do you think? Some people think it might be a recession. They, what? we can't find anyone. Where if you go to regions where they're more right on the edge of the business cycle, the unemployment rate in some urban areas can be well elevated compared to rural areas or in industries where things are booming. The thing I would say that's been unusual about this business cycle has really manifested in the district, which is normally manufacturing is the most cyclical part of the economy. And so it's really at the bleeding edge of the business cycle, and everybody wants to go out to Flint, Michigan, and various places that are industrial to get a sense of where we are in the business cycle. But this downturn from COVID was centered in services, and manufacturing actually went up people bought more cars and TVs and stuff like that. The RVs in Elkhart, I went out, but the very first speech I gave was out in Elkhart. We toured the RV plant, and the demand for RVs was through the roof. You can't believe how much, how intense the job market competition was there. So as we come into this recovery, it doesn't look like it normally does, even within the district.
So we got the jobs numbers on Friday at the end of the week. A little lighter on the number of jobs, a little heavier on the wage increases. How did you interpret them?
So they actually came in pretty much as I expected. You know, I've expected the economy to slow down in a fairly orderly way, and this number, the 187, comes in continuing that pace. Some folks would have liked it to be faster and a larger gap, but I'm comfortable. I'm not expecting this to be over in a short period of time. In terms of the wages, it doesn't surprise me that wages are still strong. You know, during this whole high inflation period, worker wages have trailed inflation for quite some time. And so we're still in that catch-up period, and I expect that we will still see strong wages. But I'll tell you, when I talk to employers, the one thing they tell me is that whatever they're setting their wage growth at this year, they're expecting it to be lower next year, and then lower again after that to get back to where we were pre-pandemic. So, you know, we got to keep an eye on it, of course, but I was not concerned too much about that at this point.
And I'm sure you'd be the first to tell me one data point isn't enough to make a decision, but do you feel that the Fed is on the trajectory it needs to be on to get to 2% at some point?
I do. You know, we are today in a restrictive stance, and as inflation continues to fall, the degree to which it's restrictive actually grows as that gap between the inflation rate and our interest rate widens. So I think that will put enough constraint on the economy that it will continue to slow. But again, I'm not expecting this to be, you know, a 2-month or a 3-month period. My outlook is that we'll still be in a restrictive territory well into 2024, and it'll just take a while for the inflationary pressures that we've seen over the last year and a half to fully dissipate and get us back to 2%.
You'll need to see some more data before you come up with a position on where you should be headed in the future meetings. But what data points particularly will you be focused on?
So I'm looking at really 3 things. The first is the actual inflation rate. So we got to make sure that inflation is not moving away from target or even starting to stall. The second is the breadth of inflation. So in all of these indices, you know, they track the prices for a number of different goods. At the height of the inflation trouble, 80% of the goods they tracked had inflation rates of 5% or more. Today, it's 28%, and this is in the CPI, and then in the ordinary times, it's 15 to 20. So we can get back to that, that's a great thing. And then the third is expectations, because as you know, people make decisions based on what they expect things to be in the future. And if they start to expect that inflation is going to be different than our 2% target, and that's not what's happening now, then they're going to make different decisions. And our economic capacity will be lower, and we definitely want to make sure that doesn't happen.
You talk about the breadth of the inflation. Let's talk about it breadth in a different sense. You are responsible for a good-sized region of the country. There have to be variations within that region. I mean, you got Atlanta, you got Miami, you got a lot of rural areas. As you look at that region, where do you see the biggest variations that we should be paying attention to?
Well, there are a good number of them. And you know, it's funny that you say that, because you know, my district is all or parts of 6 states in the southeastern United States, very large and very diverse. And right before the pandemic, we were using a theme, one district, many economies. And so when you look across the southeast, you have the big metros, Atlanta, Nashville, Tampa. These places are growing fast. There's a lot of pressure on housing as a result, but the trajectory there is very positive.
What are the best investments from your point of view, from what you understand, that will drive the most productivity?
Well, I think there are 2 things. You know, the first is I know that a lot of businesses have been thinking about how do they improve their processes, introduce automation that allows them to get more done with less. And that's happening across the board. You go to a restaurant now, oftentimes you do the ordering on a screen, and that reduces the baseline cost and increases productivity. And then the second is really to invest in our workers, to make sure that they're getting the skills that allow them to compete for the jobs of tomorrow. When you think about all the automation that's happening, all the new manufacturing, it's a different set of skills that workers need relative to what they needed in the old factory. And we need to make sure that we're investing in ways that allow our workforce more broadly to be competitive, to participate, and then get those higher wages.